Hello, everyone. As we all know, everyone is aiming at achieving the financial independence, of course, as soon as possible. And in these days, everyone does this at his own with his own way, with his own method. There are many ways to do it, and one among these methods is at least to invest the capital if you have any, rather than just keeping it aside. Actually, nowadays, with the access to speedy internet and to the different trading platforms and exchanges, this made it a bit easier for people to be able to do this themselves and maybe save themselves some of the brokerage fees that were paid in the past. But to do this, you have to learn a bit, and you have to know a little bit about the basics of the trading or investing, in order to be able to grow your capital, to manage your risks, or to maybe be able to formulate a plan and implement it successfully. So you need to know a little bit about trading. Among the very basics that you need to know are the types of orders that you can make use of. So I'm going to talk a little bit about a few types of orders that we have. The first type is the market order. This is the most commonly used, and it's used mainly by individual investors more. And this is an order that allows the investor, or allows you to buy or sell assets, financial assets, at the current market price. So you basically place your order, and you just wait that it's executed. And this type of order guarantees that your order will be filled in immediately, but it doesn't say at which price. It's the current price, current market price, and doesn't have to be the price of the last transaction of the same asset, but it's the closest current price available, the closest to the available asks and bids at that moment. Yeah. So you guarantee that it's immediately filled in, but you don't know the price. You just wait. The second type we have is the limit order. And this is an order that allows the investor to buy or sell a certain asset at a certain limit price that you yourself ask for. This one guarantees, it doesn't guarantee that it's filled in immediately, but or it's filled in at all, but it guarantees the price that you want. Because this one will not be executed unless the asset reaches the target price that you asked for, or you put as limit. Let's say, for example, you place a sell order of a certain share, for example, at $20 per share. So you want to sell at $20 per share. This means that it will never be sold for less than 20, but it can be sold for 20 or more, the closest to 20 and more. But it will never be sold for 1 cent less than $20. This is the limit order. Well, before choosing, of course, between market order or limit order, you have to check with your broker what are the commission fees, what are the fees for the limit order and for the market order, and does it go according to your plan that you made, and which one are you going to choose, what is worth or not for you, and this is according to your transaction. Third type we have is the stop loss order. This one is very interesting, actually, and it's very important. It's one of the very effective risk management tools available. Placing a stop loss is essential, of course. This is a stop loss, an order that you place that stays dormant and is not triggered unless the stock or the asset hits the price of this stop loss. It can be at buy, stop loss at buy, or at sell, according to your transaction. Let's say, for example, you place a stop loss sell order at $10, for example. This order will stay dormant until the price hits this $10 and starts going below. Then it's triggered, and then your stocks will be sold, or your assets will be sold at closest to the $10 that you placed the stop order at. This order actually limits the amount of possible loss that you can reach if you don't place it. And it also prevents this situation of the market will come back, and you holding on to your assets until the market comes back. Usually it doesn't. So the stop loss prevents the exceeding or increasing your loss. It's actually very important to use, especially before holidays, or if you know you're going to be busy, so you won't be able to keep a close eye on the market, then you're safe, and your capital at least is safe. This is the stop loss order. We have some other kinds of orders, like, for example, all or none. And this is more common among traders who trade the penny stocks. Penny stocks are the small, cheap stocks. And for example, all or none is guarantees that you, or asks that you, or limits puts a constraint on the order that you either get all the amount you asked for or none at all. So if you place, let's say, all or none restriction you want to buy 1,000 shares, for example, and it gets even more difficult or harder if you place a limit price as well, or if this stock, for example, is illiquid, not liquid enough. All of these are difficulties. So let's say you place an order to buy 1,000 stocks for a certain price limit. Then this order will not be executed except if there are 1,000 shares, exactly 1,000 shares available at that time when you placed your order at the price you asked for, or none at all. So it doesn't guarantee that you will be filled in. Your order will be filled. It's all or none. This is one type of order. There is another type of order that is immediate or cancelled. So this order actually is executed immediately, sometimes within a few seconds, and probably the rest of the order will be cancelled. So you get whatever you can get in these few seconds from your order, the amount that you wanted, and the rest will probably be cancelled. So it's very quick, actually. The other type, actually, which is very interesting, is called fill or kill. And fill or kill is a combination, actually, of the all or none with the immediate or cancelled, because this order actually asks for a certain amount at a certain price within a time limit, or not at all. So it's actually very interesting. Then we have the take profit order also, and take profit is basically a sell order where you place a limit. When this asset hits the target price, they are sold and you take your profit. So it's basically one of the sell orders, simply one of the sell orders. Of course, there are more types of orders. These are the most common, but however, they're not all offered by all brokers. So you need to check with your broker actually before that what is offered, what you can do, and what you cannot find. But yeah, you have to know which one to use and how to benefit from types of orders according to your plan. This is one thing I wanted to talk about. The other thing I wanted to speak about was the options. Options are a kind of derivatives. And what are derivatives? Derivatives are financial securities that derive their own value from another underlying asset. The other underlying asset could be stocks, could be bonds, could be currencies, commodities, whatever. So in short, or in the options is a contract. Options contract is a contract between that gives the right to its owner to buy shares at a certain strike price within a certain period of time. And option contracts have special characteristics. So they have different characteristics than buying normal shares of stock. For example, options, among the characteristics of options is that options have an expiration date, a time limit. Whereas buying shares of stock, you can own your shares forever, or for the time that, for how long you want to own them. You can sell whenever you want and buy whenever you want. Well, whereas options have an expiration date. Second, options have a certain strike price. It gives you the right to buy the shares within this time limit at a certain strike price a certain strike price that you want, according to your technical analysis, or according to your analysis in general. And third, we said options, they have expiration date and they have strike price. Yeah, and they have the option contract multiplier. So for the shares of stock, you can buy 1 share, 2 shares, whatever you want. But for the options, there is a multiplier of 100. So you can't just buy one. So which means that if the option price is $1, then the premium you're going to pay is going to be $100 because of this option multiplier. And we have 2 types of options. We have the call options and we have the put option. Call option gives you the right to buy 100 shares at a certain strike price within a certain time limit or before a certain date. And the put options is a contract that gives you the right, and not the obligation, but gives you the right to sell 100 shares at a certain strike price as well, within a time limit or before a certain date. Let's talk a little bit about the call options. Let's say, for example, that there is a certain stock trading now at, for example, $12, and you've done your fundamental analysis, technical analysis, all your due diligence, everything, and then you expect that this share within 2 months is going to hit the 15. So, but you don't want to buy this share now for the $12. So what you do is you buy the option contract for this share. You choose, for example, the time date of the 2 months that you want, and you choose the option available for example, $10 per share, the strike price, I mean, of $10 per share. And let's say that this option, the price costs, for example, $1.5. So now you buy an option that the price is $1.5, so the premium is $150, strike price of $10, and you have the expiration date within 2 months. This is the contract that you buy. Let's say going forward, the price of the share really started increasing. So while the price of the share increases, also the value of the option contract that you have increases, because the price is going up of the share, while you have the right of buying 100 of these shares for a less price, for the strike price that you chose. So as the price of the share increases, also the value or the price of the option increases with it. And the closer you go towards the expiration date and the strike price that you, and the price that you're expecting, the higher the value of the option becomes. So let's say going forward, the stock really hit the $15. Now, you have the right with this option to 100 shares of stock, price of $10 each, while the share is trading at 15. So you can exercise your option and buy 100 shares for $10 each, and then sell them on spot for 15 each, so 1,500. So you buy them for 1,000 and you sell them for 1,500. You have $500 of profit, but you paid, of course, the 150 for premium. So you're left with $350 profit for with a $150 investment. So it gives you like 230% return, which is very high, of course. But in reality, this doesn't happen. You do not need to exercise the option and buy stocks and sell them, because the option value itself also increased with the price. So in reality, what happens is that you go ahead and you sell the option, the contract that you have. Now there is a rule that the option value should include the amount of benefit that the owner can get if he exercises this option. So now that you have an option or the right to buy shares of stock for $10 each for a share that is trading at 15, so the value of the option should be $5 or more. So you just go ahead and you sell your option, and you get almost the same amount of money that you would get if you exercise the contract. It's the same amount. However, if you go ahead and calculate the percentage return growth due to the increment in the price of the share itself, and you calculate also the percentage of growth of return due to the increment in the price of the option, which is smaller, you will find that the percentage of growth on the return of the option is much greater than the increment of the stock itself. So the stock itself might increase, for example, 2%, while the option might increase for example, 10%. This means that trading options gives you leverage, and that's why traders, they do prefer to, or they do like to trade in options and rather than trading the stock itself, because it gives you leverage, and that's how they make money out of the options. Now, this is the call option in simple. The put option is actually just the opposite. I'm not going to talk a lot about it, but you have to know that the put option gives you the right, not the obligation, but only the right to sell a certain stock at a certain price. So what happens is it works the other way around. If you, for example, expect that a stock is going to decrease or go down, then you buy this put option at a strike price that is higher than what you expect is going to be. So it's an inverse relationship. So the more the stock goes down, the higher the value of the option that you have. So it's just the inverse relationship. I'm not going to talk more about the put options. I'm going to leave the options here. This is what I wanted to say about the options. And I want to share my screen actually, and maybe do a very quick technical analysis for the Bitcoin perpetual futures. Okay. Yeah. Okay, I hope I'm sharing my screen now. So this is the BTC-PERP futures, Bitcoin Perpetual Futures. And I've been looking at this for a couple of days. Well, I can see here this line where there was 2 points of so we can see here 2 points of support, or 3 actually, and then it broke downwards, and we can see here a line of support also. Then it broke upwards and broke the other line of support here, and 2 points of resistance as well, and then it broke upwards and downwards again. I can see here a pattern of a bearish flag. I think I'm expecting it to go a little bit downwards, maybe until this line of support here, and then before it starts going up again. So actually, if I was to trade this now, I would short the stock, short the futures now, this future now, for at a level at one there. I would short the stock, and my entry price would be 19158, for example, now, and I would place. That's where I would place my my entry price now, and then I would place the take profit. Yeah, at 18897. This would be a short, I think, a short trade. The risk reward ratio is 1.81, so not really very attractive, but it would be a short and small profit trade. And I would place the stop loss here at 19295. At this line, actually, where it was, this line was a line of support here and here. I would expect maybe that it would be also, yeah, I would place, that's where I would place my stop loss. And the take profit would be here at this line of support also. I don't think it will go less. So that's where I would place the take profit, short position. So let's say if I have a capital of $1,000, I would go for a risk percentage of 2%. I'm not really confident about it, so 2% I think would be reasonable. A risk amount of $20. This is the amount, and then to calculate the position. We do the risk amount divided by the percentage distance to the stop loss. So 20 divided by, and that's where we get our information. The distance to stop loss is 0.79%, so 0.0079. So I would start with a position size of 2,531. And that's how I would short the stock. And as I said, yeah, and then to buy again and make up for the transaction, I would do it at 18863 here at this level. Yeah, it's a bit volatile. I've been watching it since yesterday, actually, and it's going volatile. But yeah, seeing this pattern, this bearish flag, and also a downward pattern here. So I would think it would go down a little bit more until this line of support here, before it starts going up again, being very volatile. So this was my, yeah, so this was my presentation, and thank you for listening.